Brad Williams, Frugal Finance, Return on Equity. Return on equity looks at the return to equity investors using the accounting net income as a measure of this return. Again, defined generally, return on equity equals net income divided by average book value of equity in a project. To illustrate, consider a 4-year project with an initial equity contribution of $800 and then the following estimates of net income in each of the 4 years. Here, all we're going to do, here's a simple calculation. That's just pretty straightforward. Like the return on capital, return on equity tends to increase over the life of the project as the book value of equity in the project is depreciated. Just as the correct comparison for the return on capital is the cost of capital, the correct comparison for the return on equity is the cost of equity, which is the rate of return equity investors demand. A project's risk profile and the amount of debt the company has taken on should be explained by the cost of equity. A project with a higher return on equity will be considered better when selecting amongst mutually exclusive projects with comparable levels of risk. Net present value, the sum of the present values of the expected cash flows on the project net of the initial funding. The full estimate of cash flows described earlier in this section requires subtracting out CapEx and changes in non-cash working capital, but it is far too volatile on a year-over-year basis to produce consistent measures of return on equity or capital. Discounted cash flow measures. Project decision rules based on discounted cash flows not only replaces accounting income with cash flows, but explicitly factors in the time value of money. The two most widely used discounted cash flow rules are net present value and internal rate of return. Net present value, the net present value of a project is the sum of the present value of each of the cash flows, positive as well as negative, that occur over the life of the project. The formula is net present value of project equals the cash flows divided by the discount. So you have cash flows, the discount rate in the life of the project. Consider a simple project with an initial funding of $1 billion and expected cash flows of 3, 4, 5, and 600 million over a 4-year period. Assuming a discount rate of 12%, we're going to get the net present value of equals 324. Here it is right here, just the numbers discounted over time. And notice here, keep in mind that we need to change the timeline, and you'll see each year I'm using number 2, number 3, and number 4. And then we just add those up and we get 324. Once the NPV is computed, the decision rule is extremely simple because the hurdle rate is already factored in the present value. Decision rule for net present value for independent projects: if the net present value, if this number here, if this net present value is greater than 0, accept the project. 324 is greater than 0, accept the project. If the net present value is less than 0, reject the project. Note that an NPV that is greater than 0 means that the project makes a return greater than the hurdle rate. So here, they're making a significantly higher return than the 12% rate. I think we discounted this at 12%. Yeah. So it's going to be probably 19 to 20%. Net present value from the company's point of view, Capital Construction Door Company, worksheet 4.2, we calculate the present value of the cash flows to Capital Construction as the company from the proposed door company using the cost of capital of 25.48 as the discount rate on the cash flows. So here we have these cash flows, 1.5. We're going to discount these back, and we're going to get this net present value of 98.7 negative. Keep in mind, the construction project has a net present value of negative 98.754, hinting that it is a project that should not be completed based on the project cash flows and the high cost of capital of 25.48%. Net present values from the company's point of view: Granite Quick Charge. In estimating the cash flows to discount for Granite Quick Charge business, the first point to note when computing the net present value of the proposed Quick Charge business is the fact that it has a life far longer than the 10 years shown in worksheet 3.2. To bring in the cash flows that occur after year 10, when cash flows start growing at 1.29%, the inflation rate forever, we draw on a present value formula for a growing perpetuity. Present value of cash flow after 10 years is equal to cash flow, divide this by the cost of capital minus perpetual growth. Gives us 300 times this number. It's called the terminal value. We can call it perpetual, but this is the terminal value. The majority of companies, that's where the value is generated. The cost of capital of 6.35 is the cost of capital for Granite Quick Charge. This present value is called the terminal value and occurs at the end of year 10. Worksheet 4.3 shows the net present value of the proposed project computed using the cash flows in millions of US dollars from Worksheet 4.2 and Granite Construction's cost of capital in dollar terms of 6.35. Here we're just going to calculate this. Here is our net present value minus 446, an internal rate of return of 5.04 with a cost of capital of 6.35%. What's the general rule? If your net present value is negative, or if your return is less than your cost of capital, what are you going to do? The net present value of this project is negative. This suggests that it is a bad project that will lose $446,000 in lost value for Granite Construction. Net present value and current choices. When reviewing a project, cash flow and discount rates can often be calculated in one of several currencies. For a project like the Granite Quick Charge business, the obvious choices are the project's local currency, Mexican pesos, and the company's home currency, US dollars. But we can, in fact, use currencies to review the project. When switching from one currency to another, we have to follow the following steps. Calculate the expected exchange rate for each period of the analysis. For some currencies, euro, yen, or British pound, we can calculate expected exchange rates from the financial markets in the form of forward rates. For other currencies, we have to calculate the exchange rate, and the best way to do so is to use the expected inflation rates in the two currencies in question. For instance, we can calculate the expected Mexican dollar exchange rate in N years by using expected rate Mexican dollars to US dollars equals Mexican dollars divided by US dollars today times 1 plus expected inflation US divided by 1 plus expected inflation Mexico. We are assuming that purchasing power ultimately drives exchange rates. This is called purchasing power parity. Convert the expected cash flows from one currency to another in future periods using these exchange rates. Multiplying the expected cash flows in one currency to another will accomplish this. Convert the discount rate from one currency to another. We can estimate discount rates in one currency to discount cash flows in another. We will once more use the forecasted inflation rates in the two currencies to convert a discount rate from one to the other. The following formula can be used to convert a US dollar cost of capital into a Mexican dollar cost of capital. Cost of capital, Mexican dollars equals 1 plus cost of capital, US, times 1 plus expected inflation, Mexico, divided by 1 plus expected inflation minus 1. Here's the formula right here, same thing. Computed the net present value by discounting the converted cash flows from step 2 at the converted discount rate, step 3. The net present value should be identical in both currencies, but only because the expected inflation rate was used to calculate the exchange rates. If the forecasted exchange rates diverge from purchasing power parity, we can get different NPVs, but our currency views are then contaminating our project analysis. Net present values in Mexican dollars, Granite Quick Charge. In this example, we computed the net present value for Granite Quick Charge in dollar terms to be negative $477,000. The entire analysis could have been done in Mexican peso terms. To do this, the cash flows would have to be converted from dollars to Mexican pesos, and the discount rate would then have been Mexican peso discount rate. To calculate the expected exchange rate, we will imagine that the expected inflation rate will be 3.5% in Mexico and 1.29% in the United States, and use the exchange rates of 20.4 Mexican per US dollar in August 2021 as the current exchange rate. In 1 year, the projected exchange rate will be expected exchange rate in year 1 equals 20.4 Mexican pesos times 1.035 divided by 0.0129 equals 20.84 Mexican pesos. The same analysis will generate exchange rates for each of the next 10 years. The dollar cost of capital of 8.67 calculated in example 3.1 is converted to in a Mexican pesos cost of capital using the expected inflation rates. Cost of capital equals 1 plus cost of capital dollar times 1 plus expected inflation Mexico divided by 1 plus expected inflation US, 1.0635 times 1.035 divided by 0.0129 minus 1 equals 8.67. Worksheet 4.4 summarizes exchange rates, cash flows, and the present value for the proposed Granite Quick Charge business with the analysis done entirely in Mexican pesos. So we're going to see cash flows, Mexico exchange rates. I didn't use this number here, this 20.84 throughout. And then cash flow Mexican, and then present value equals, in Mexican terms, negative 8949. And then you convert that over to the current US currency, and it's the same negative number. Note that the net present value of the Mexican pesos is negative 447,000, exactly equal to the dollar net present value computed in 4.4, converted at the current exchange rate of 20.04 Mexican dollars. Net present value in dollars equals net present value in Mexican pesos divided by current exchange rate equals 8949 right here divided by 20.04 equals negative $447,000. Brad Williams, Frugal Finance. Thanks for watching.